All right. And we're live on Energy Superheroes. Today we have Karim Megherbi. And Karim is the founder and CEO of Orison Invest. And Orison is a pretty incredible firm that helps projects all over the world in energy transition get built and get financed. And we're going to talk about what that looks like. Karim has 17 years experience in originating, structuring, and developing and closing IPP transactions around the world with a special focus on renewable energy and emerging markets. Welcome to the podcast, Kareem.
Thank you, Peter, for inviting me.
It's
Very
great to
happy to
have
be
you.
here.
You have a wealth of experience in project development and origination and finance, which is super important because how can we really do energy transition? Projects aren't getting built. That's what has to happen. Tell me, Kareem, from your perspective, what makes a good project in today's market?
Uh, just to make, make it clear, I focus mostly on, solar and wind assets. So that's where we work. That's where our expertise is. So I like to focus on this type of projects. But, if you want to discuss other types of assets, we can also discuss that. But, so solar and wind, it's connected to the grid or CNI, meaning that there are, they sell electricity to, numerous ways. You have spot market, you have, PPAs with utilities or corporates. And so, in our markets, also in many emerging markets, PPA is not enough. You also have some, from time to time, the need of a sovereign guarantee, when you work in countries where only the commitments of the utility is not enough and the regulatory framework also has some kind of gaps. And so you'd rather have, these gaps filled with a sovereign guarantee of some type, different types, put call option agreement, project support agreement, implementation agreement, whatever, it's just kind of freeze the tax regime and the convertibility and so on. So I'd say the type of project we're looking for and what is a good project and the project that our investors are looking for. That's number one criteria for us because we want to, we're looking for two types of projects. The one is the ones that we want to promote because we see value and they are very much in line with the energy transition and our net zero scenario and so on. We like the developers. We feel the projects are credible, that we see the path towards financial close and transaction close. So we see a clear, within the next 18 months or a bit more, a clear capacity of the project to be closed and plus the impact on the energy system and local communities, etc. is strong. So we like these kind of projects. And in this case, we try to establish connections with investors whose criteria would actually meet with this type of projects. So that's number one. And number two, we're discussing with investors and establish, very strong relationship with them. So we discuss what they like, green shields, ready to build, COD and where the market, their core markets or their target markets. And so we try to find the right projects for their criteria because once again, our goal is to accelerate the energy transition and accelerate transaction flows, transactions. So, if you start to have projects where, half of the criteria are met and the other half is complicated, etc., then there are some, risks that the transaction may not happen. So we try to avoid that and we try to, hunt for projects where investors are, keen on, on investing.
No, that makes sense. And have you seen returns coming down over the last number of years, or are they fairly stable in some of these markets?
Well, that's a good question because we're covering, when I say emerging markets, we're covering Asia, Central Asia, we're covering sometimes also South America, Sub-Saharan Africa, So there are very different dynamics there, and I would say it depends on the development status of the country in terms of renewable energy. There's always, the very beginning regulatory framework, the country fails and there is a big stop because either there are congestions on the grid, either they are, prices were too high, so they need to stop. And then there are retroactive laws, that completely destroy the market and then consumers, it's nothing. And so you do have all these dynamics in, all countries, they make some mistakes. We see a lot of them. And so, markets are very different from one another. And plus you have macroeconomic conditions also on the country. And so let's take an example, Pakistan recently, there was a very big boom at the, a few years ago. There was a lot of projects and other countries really in a bad shape. So, whatever returns you get there, you just won't invest. So altogether, what we see is that we do have opportunities of double-digit returns in emerging markets, clearly, even in transactions where you have a sovereign guarantee, there is no currency risk, and markets is, quite, I would say, low risk in terms of emerging markets. So it's established. There are already transactions which have been closed in the energy sector with DFI, development financial institutions and so on. So in this kind of country, it's still possible to find double digit projects. And then you have also similar countries where, like Malaysia, for example, where it's very competitive and the sector is well structured, and you have very strong local players which are well organized, and they're trying to drive the cost down, and they are successful in doing it. And so here you have single digit returns, but generally I would say between, so in terms of project returns, between 8 and 12, you can still find them. And, there's, for example, the case of India also. Case of India, you're clearly in the 10, 10 in the 10%, return, but you see it's in dollar, but you're paid in rupees. So basically, yes, markets is, the interest, the returns are going down. Yes, but it's still attractive for some investors, but they need to, no, they cannot think like, okay, emerging markets, I need 18%. We have this case that does not work. There's no opportunities like that, almost zero. It's below 15%. If not, you do have strong investors, which are well structured and organized, international investors to cover these markets, even the most complicated ones. And above 15%, you will find you won't be able to be competitive at all.
And oh, very good. I think that's really good guidelines for people to think about. What are some markets that maybe not everybody's thinking of, but that you think over the next 5 or 10 years are going to be good markets?
Yeah, that's exactly the questions we ask ourselves because we want also to invest in some assets. That's exactly, do we still have these kind of opportunities in the market where, because, we have thousands of people, of companies, obviously developing everywhere in the world for quite some time now. And, there are very few countries which have not, started their development. We saw that, for example, in Kazakhstan a few years ago, and with our strategic partner, Total ERN, we did some acquisition there successfully, and it was very good, 100 plus megawatts. And the market, unfortunately, is a bit, has been stopped. So there are few countries like that which are there, but these countries are very complicated, like the Philippines, like Laos, Cambodia, and so on. These markets, they will have to do their energy transition, these countries. And they are still at the very, they had some development a few years ago and it stopped, and they will resume. And everybody is, know that now you have strong local players also. So for international developers, it's very difficult to enter these markets. But you have, for example, this opportunity in the Philippines and so on. But they're very complicated. Then it's challenging. Today, the regulatory framework also is complicated. It will change in 2 years because they will not be able to attract enough capital based on the current situation. And as they will realize that, like Vietnam, for example, they will change. It will take a lot of time to change that, but it will happen. So Vietnam, typically, people invested a lot of money there. There was a boom, and now it has stopped. And people are waiting for a new regulatory framework for a few years. Now, how this new regulatory framework, they understand that they cannot have the same PPA and so on. So they will change that, and now it's going to be attractive. So some people, they are trying to put already their pieces, restart somehow their development in hope that in 2 years it will change. So you have some, you have few countries like that in Southeast Asia, but you need to be patient and it's kind of risky, right? You start to invest in development now. So, but you do have some investors trying to do that. Now you can wait also and local developers, they will take the risk. And once they reach ready to build, then you need to be ready to pay a good development fee. That's another way to say it. But, and you can still get some attractive returns.
Well, you bring up a good point about the development fee. As these markets become more and more complicated, are developers asking for more on the development fee, or do you find that investors still have the leverage when it comes to negotiating?
Well, that's a very good point. For now, it's driven by developers. In developers, they set their development fee and in some markets, they wait for investors to agree on their fee. And if not, they lose their deals. That's the developers we're dealing with. And that's really bad, right? Because there's an imaginary market, an imaginary fee and which never materializes. And people are losing, millions in terms of development because they really stick to this price. And so you have some markets like that, to be honest. And Vietnam was one of them. Very high development fee, which didn't make any sense. But the few investors, they agree on that. But, at the point in time, there was no more investor actually to agree on that price. And people have wasted a lot of money on that. So for now, indeed, complicated markets means high development fee. That is for sure. We see very high development fee, which is kind of attractive for developers, but it's so risky because you need sometimes to buy land, and buying land, how can an international developer start to do that, right? So you have really local developers taking the risk, bringing it to a certain stage, and then trying to get a high success fee. And if they are well organized, they just build, and start to raise funds, etc. So it depends really on how structured and mature is the local industry in the market.
Oh, that makes sense. What are some of the ranges you're seeing for the developer fee in these kind of emerging markets?
So when the market is complicated but not attractive, like Nepal, we see because we work really everywhere, right? And we do have very good transactions actually. Yeah, so it's below 80, for example, I would say 50, $80,000 per megawatt. When it's very complicated, but very attractive. Vietnam, it's going to be above 250. But let's not forget Europe also, because it's not emerging markets, right? In Europe. And in Europe today, we see very high development fee also. Huh? So maybe, we have this approach which says that, this is really high, etc. Because indeed we see success fee similar to very attractive markets in Europe, like Romania, for example. Today it's a very hot market in Romania. And we see some kind of similar shit, but at the end of the day, the risk is very different. It's much riskier to go in Vietnam with, a PPA with no take or pay, you know, no take or pay clause. If I cannot finance it because I know there are numerous gaps in the PPA and so on. So these are very risky, but still the development fee is high. So it's not crazy high, right? But still for, developers, they may find difficult to, squeeze this development fee and basically give away a lot of premium and, potential value that, they may hope to gain in the future. So it's a kind of, you stretch too much the return and so on for this kind of transactions. So at a point in time, you can sort of try to balance, say, what do I prefer at the end of the day? Should I go to, Europe and have very similar return, or should I stay there because there's kind of potential, etc. But should I give away my upside and so on? So there are some questions like that, but we still can structure something. That's where we add value actually, with the relationship of developers trying to bring some, ideas of having new, established partnership rather than, one shot sale and so on. So we can negotiate some interesting. That's the range. 100, 300, so very attractive market.
And no, that makes sense. We see a lot of developers. I'm sure you see really a lot of developers. What makes a good developer in your mind? Qualities of the developer make them likely to get the project over the finish line versus maybe make you take a step back.
Yeah, it's a very interesting question because where there are two types of developers with whom we're dealing. One is very inexperienced developers, but they do have all the relationship with the governments, with land, etc. So these are real estate companies and people who are not actually in the power sector. And we do look at these transactions, but at the end of the day, to be fair, we're not wasting any more time now if we feel that even as a real estate developer, they're not doing the right thing. So their team actually should have a whole process where they do the due diligence on the land, etc., which is something that they do actually in their own activities, which is not the power sector, right? But they need to, you know, take this process and professionalism from what they're doing and put that into the power sector. If the initial professionalism and process is not there, then you will not see it in the power sector, and then it's a disaster. So we don't want to waste our time here. So we try to work with professional people who can, communicate with, who are conducting studies, who are, asking the right questions in terms of ownership of land, in terms of grid, in terms of, having the view that they need to close the transaction. They need to, discuss with an investor if they are not investor themselves, and they need to discuss with the bank. And so convince the bank to finance that. And they understand that it's difficult. You can, lose everything because you forgot about, the environmental study, and there is a special ant, ant or a special tree, that you can attach at all. And, there's no project because of this one single tree, And so, they need to be aware of that and understand the complexity. And so that we feel at ease because we feel, okay, these guys, they understand where they're going. And then you have, for developers who understand, power sector because they are part of that. And once again, we try to focus on developers who want to communicate, who wants to, they share the studies, they share information, they don't hide information. They put the investor at ease and understand that they need to establish a trustful relationship, that is important, because at the end of the day, even if you are professional, but you hide information and that you bring this information at the end, just right at the end, and then, you have wasting all your time. So you need to have, confidence, you need to be confident and to have a good reputation. We work with people, we check the reputation of the people, we discuss with some of their friends and basically, and also as originators, our originators, they're local. So we work, we want to decentralize actually this activity, and we only work when we know personally the CEO of the group with whom we do. Only that, because there's no way, we can't, call the CEO or, senior, people. They say, hey guys, what you're doing, are you sure? So that we really pay attention to that, trust, professionalism, good reputation, people who ask themselves the right question and don't think it's easy to develop projects. Yeah, that's very important.
And no, those are all great qualities. One thing I'll add to that we always look for is developer has to have a lot of, we call it skin in the game, meaning they have to have their own cash in the deal. We certainly like it when a developer has done a lot of work, and there is value in work, of course. But we also find that the developer has to have some of their own cash capital in the project as well. How do you guys think about that in terms of developers putting their own cash into the deal?
Yeah, that's a good point. You see, there are markets where the value is completely decorrelated from the cash that you put initially, because to reach a certain stage where you have enough permits and authorizations, it's less and less true. But we saw that, for example, in Kazakhstan a few years ago, development would cost 200, $300,000 to reach a stage where investors could be interested. although they are very true investors because it was in Tengi, right? So it's a controversy. So we work with Total because they have a very big investment in Kazakhstan, and that's why. But still, you see, so this discrepancy between the value of the project where you could be, 100,000 or a megawatt, whereas actually when you have invested very little money at this stage, depends really on your appetite and how you see the complexity of finalizing the development at the end, I would say we have generally, so you're right. Yes, we like investors putting some money, but we like also investors putting the money that we don't feel comfortable to put, like for example, acquisition of land, regardless of the price, regardless of, how much it costs. If there are some activities that we can't do, we don't have the understanding of that, of the price, of the value of that, etc. We're not capable to do that. Even a due diligence on the land cost, you can just call a friend and blah, blah. And so this value has no value actually, this study has no value. So we're very careful about that. And so what we don't like, we push that to the developer. And that's where, yes, that's where I recognize that, okay, this guy, he understands that this money, we don't want to put that because we don't understand what it is, So you do that, you deal with that. Again, it's not only land, but some permits, with there are some administration fees. We don't know if we bring that, if we go to the local authority, we don't know how much they will charge us, etc. So, we don't want to be in this position where we can't, assess the value of a certain task. So what all the different services, studies, permitting process, land, which are really the core activity of the local developer, we like it, to cover it. Now you do have investors, but when the regulatory framework is clear, that would be ready to kind of support all the development costs, but then the success fee would be very little. That's, much, much lower. So they need to understand that, but an investor, they need to be very comfortable with the development process.
That makes sense. It leads me into my next question, which we talked about what makes a good developer. What makes a good investor in your mind bring into some of these
Yeah.
projects?
These are excellent questions. Investors have to be, well, there are a few things. One is reactivity. These markets, they are complicated. You need to adapt quickly. You need to take swift decisions. So we help them. We help them because that's our job actually, to make them understand, okay, this is the regulatory framework. These are some issues. There are some bottlenecks. Be ready for that. Be ready, etc. So we prepare them, at the very beginning because we already see some problems happening in the future. And so, no problem that does not exist, So there are problems, and the difference between investors who are going to close and investors who are not going to close is how they're going to manage these problems. They are not the ones who are avoiding the problem that does not exist, So we kind of prepare them and say, okay, you will have at a point in time to take this decision. What do you need to take this decision? If you need 3 months, tell me what are the different information that you need to make you able to take this decision in 3 months, because in 3 months you will have to take this one. So flexibility, understanding of, of that issues of having to take some decision at a certain time and prepare for that, and not delaying things and, again, asking new questions, etc. for the same issue. That is important because time is really the enemy of developers in these markets and of investors, at the same time. So reactivity, I would say, prepare, understanding the markets, that understanding that they're not in France or Germany, right? So if you go to Sri Lanka, you're not going to Germany. So don't expect Sri Lanka to be like Germany. That's for sure, So, and we as an investor, we can't picture that also. We can't tell the investors, don't worry, everything is fine. Sri Lanka, perfect. No worry. It's like Germany, At the moment I said that, just don't hire me, never, So just avoid me, So we'll give a clear picture, but as an investor, you need to understand what it means, right? So don't think if the PA is in local currency, it's in local currency. Don't start, in 3 months, 5 months after some development, then you go to your investment board and say, but this is local currency. So what are you doing? Be realistic, open your eyes. Don't think that the country will adapt to your needs. That will not happen. In very few cases, there are some cases, we can do that. In some cases, discuss with the government, get some kind of for guaranteeing its job, we can do that. But it's when it's material, you need to tell us, and so we need to be ready for that. So that, and then, be ready to spend money. I mean, this is clear. If you make some commitments. So, if you do some development, you need to pay for the development. There is a budget. So, we're going to this budget will happen. I mean, this activity, they will be there. So you need to be ready for that. And in terms of return also, if you want to be not even a good investor, I mean, an investor, just an investor, to deals, well, you need to, adapt also to the country and what we discuss actually on a case per case basis. What is the expected return given the PA price, etc. So if you understand all that, this framework in terms of returns, how it is calculated, in terms of overall transaction risk, and also in terms of reactivity and decisions that you need to take. So if you are prepared for that, then yeah, that's where, we're likely working with you as an investor.
No, that's very good. I'll break investors into just maybe some categories and you tell me if they're relevant or not. So we see family offices, of course, which are big pools of family capital. We see funds, which could be private equity funds, infrastructure funds, which we categorize as financial investors. And then we also see strategic investors. And we define strategic as they have some operational capability. Maybe it's a company and they have engineers, they have expertise in the actual project beyond just financial. What are your thoughts on those categories of investors? Which ones are relevant for you and what are you guys sort of seeing and maybe pluses and minuses?
So we work with the three of them. Family office is a bit complicated for emerging markets. I mean, they really need to like that, to have already a DNA, and ready to take this risk because, these are a bit, there's a lot of money, honestly, there and, at stake. And there are some risks that they are very not used to take, So unless they have a specific profile, and you can find them out. We do see family office even in India, and I think there is even an American family office actually active in India who recently did some acquisition, but I forgot the name. You may know. And I think I saw them because that's where actually I thought that, oh, maybe I should go to the US and start to pitch some family offices. They were looking for also investments. We do have a lot of transactions in India. And so we thought that, okay, let's see, many developers in India, they're looking for new sources of capital because, there's a lot of gigawatts per year. And so I saw a family office in India. I thought, okay, it seems very interesting. So you do have some probably specialized, family offices, but you see, that's not for everyone, right? So they really need to have very clear strategy on what they want to do in emerging markets, where they want to put their money, etc. Maybe it's South America, maybe it's, etc. So we saw them and it's interesting, we saw that also in Cyprus. We're working with a family office, a friend of mine, by the way. And it's all about relationship also, with the family office. And if you feel comfortable with the way they take decision, and somehow we also work with big groups in the Middle East, which are owned by one family, so they are not family offices somehow, it's not the same profile, but at the end of the day, it's there's a kind of, this family who owns that. And so they discuss that. So yeah, you need to be careful with the decision process, I would say, this is to be clear, you don't want changes. You don't want, development. The transaction is, if it's just a transaction close, so the deal is in operation, it's between 6 and 12 months, you close. It's 12 months, usually transaction to close it, So you need to, be ready for this 12 months. If it's in development, then you have not only to close the transaction, which means your relationship with the developer, but you need also to develop for 2 years, 3 years, Are you going to be, you need to be ready for that. And you can't change in the middle, that's also if you do that. So that decision process and that long-term, view and strategy needs to be very clear with family offices, I would say. Then, equity investors, that's, as a former banker, they speak the same language, the same language. So show me your financial model, what's the upside, etc. It's good for me. I like it. It's clear. Now the question is always about majority and minority in transaction. That's, the big discussion. If you're a minority investor, okay, but then who is going to be the majority investor? So again, the whole transaction is about the majority investor at the end of the day. So you need to look at, to be fair, we have mostly connection with majority investors, and we would love to have more minority because that's a request in markets where it's kind of trusted by local investors. And so they're looking for minority, they want to keep the control and they want to invite minority investors. We don't have relationship in such profiles. So yeah, and then strategic investor, that's what we have. We have two strategic investors, Total RN and Technique Solaire. These are, IPPs, strong IPPs. They have a very clear strategy, etc. So here I can tell you it's both easy and difficult to work with because they have their own strategy. They say yes, no, well, yeah, this is, you work with very big partners, very big, groups. They're dealing with gigawatts. You have your small 100, 200 megawatt project and they discuss, etc. And at a point in time, after, because they can't invest too much time, right, from the very beginning. So you know the decision only after a certain point, which in this point, it's maybe 3 months of work. So we need to, our job here, because we understand that you can't change that. You can't expect them to change that. That's not how they're built. That's not how they work. Their decision process is like that, and it will remain like that for good reason. So our job is to be able to keep this transaction for this investor for 3 months. And while at the same time tell the developer that, look, we need to wait for the final decision because we need to be transparent with both parties. We can't play a game. Yeah, it's going to be fine. Don't worry. If I do that, our reputation is dead among developers. No, with investors, they will be happy. Developers, they will not be happy if I stop this game. So our job is to keep this thing alive and make sure that the decision process of these big groups and strategic investors, the transaction timing and dynamic would fit to their decision process, So that's the tricky part with these investors. But, when you know them very well, when you understand their strategy, etc., you kind of know if this transaction will fit to their investment committee. So we separate, one is easy transaction when you're sure, okay, that's this one. We'll say, okay, no problem, guys. Yes, they will say yes. In complicated markets where we know that, oh la la, this is a new test. We'll see at the investment, let's work, etc. We just tell the developer, say, we'll try, okay? Your project is complicated anyway. So let's try, invest some time and let's see,
No, well, you certainly hit the nail on the head. And especially when I'm thinking about what investors we're going to work with, that directly affects the timeline because we do find that investor in the middle, the financial investor, we speak the same language. I might be able to get to a yes, no in 5 minutes, but with the strategic investor, exactly like you say, it might take 3 months to get to a yes, no. So it's a very different process. And on the family office side, I'll say that for the most part in the US, family offices like more simple type of investments like real estate, more basic investments. But we are seeing with the increase in interest rates, some US based family offices that had traditionally looked at real estate start to move over now and look at energy transition. But they have to understand it. It has to be, they have somebody internal, or maybe the family made the money in the energy sector, because you're not going to find, if they don't have the internal knowledge, everybody understands real estate, right? It's a simple sort of thing.
Yeah.
Whereas you get into something like carbon capture and storage, and there's a lot more complexity and nuance and changing of these transactions. Whereas you see a real estate transaction, it tends to be very fully baked, let's say, is the word that we use. So one thing we always talk about, Kareem, is some of the deals, they have a lot of, we call it hair. Okay. The deal has hair on it. And what we mean by is there's some kind of issue that has to be solved. So what's one of those things that you see that a lot of developers miss that ends up being, once it hits your desk, you're like, time and time again, you're having to resolve that or fix something. And I'll give you my example is, we'll see offtake LOIs, but the offtake LOI may be a take or pay, but it's completely dependent on the market. There's total merchant risk. So the developer hasn't thought through, how do I get the off-taker to commit to some sort of price floor, or even could be a band, to de-risk this investment for investors. And we always see developers wanting to increase returns and not thinking in terms of, how do I reduce risk? But that's what we see a lot, that ends up being the deal has hair, and then we have to go back and try and fix those things before we bring it to market.
No, that's a very good point. Risk versus return. And yeah, some developers are more focused on their development fee and the financial model, thinking that forgetting about the project is a pile of contracts. And so what you have in your financial model these are just numbers, but the contracts, they say something else. They are not sure, these numbers may not be established, it's not clear, so you put the numbers you like, but if the contract says something different, then as an investor, I won't follow the contract because I don't care about what it says spreadsheet. So yeah, so that's correct. Okay. In emerging markets, number one is land. Number one. Number two is land. So you need to have that in mind.
That makes sense.
Uh,
And because the land, maybe the laws are difficult, and
uh,
sometimes you don't know if
so
you have site control or ownership.
yeah, so there are a few reasons why it's like that. So one is, yeah, obviously ownership. If I take, I can take the worst case, but, let's give you an idea. Bangladesh, it's a piece of land is owned by 1,000 of people. And if one of them is dead, then you need to go to the previous generation. That's another 10 people. If 10 people are dead, it's another 100, etc. And if some are dead, so it's like a madness. The documents are sometimes not clear for historical reasons. And if you want to go through the diligence process, you have to establish very clear due diligence, working with your own due diligence. I mean, if you go to the bank, they have their lenders due diligence. You own, so as an owner, developer, your own due diligence. You have to preempt that and obviously conduct a very thorough due diligence, which is super costly. Time, it takes time. You don't want to invest that at the very beginning. So you kind of trust, and kind of say, okay, I would see, or maybe 30%, Bangladesh was typical for that. 70% of the land is done. Yeah, okay. And none of the project achieved this last 30%. No. so, so, so that's a tricky part because, you need to invest time, resources that you don't want to at the very beginning. And if you start to, you already have $1 million outside, on a project where there's nothing. So you kind of try to adapt your development process and when you spend money, etc. But in some countries, it's very difficult. So it's again for local developers, mostly local developers, they may not understand, saying, oh yeah, don't worry, I will manage that. So you find yourself sometimes in project, even in operation, even financed by lenders that actually we have the case today in India that you realize that there are still some pending issues on the land. And so you do have your CPs, on your share purchase agreement where you have a list, half of them is in land, half of your CPs are the land usually. So land is a very complicated issue. And so you have, this regulatory framework, blur area documents which are missing, authorizations which are not there. You need to transform also, change the use of the land, from agricultural to industrial. Committees are required. Sometimes you're missing a document because this process, this is new, and you have your law firm, which is, super good law firm and working with the local law firm. And now they realize that there is a law for that. And so, hey guys, there is a law, already there is a law. So we need to go again on the committee, but no, I don't want, so it's like, it's really crazy. So land is really crazy. And that's number one. Access to grid, we do have some problems, in some countries of risk, take up a risk, etc. We do have that, and so you need to look at that. Where are you going to be connected? Distribution network because your plant is small, or because there are numerous 10 megawatts, as a portfolio. Have you looked at the availability of the distribution network? If you're connected to the transmission line, transportation, okay, fine. So have you conducted a grid study? Yes, no. Are you sure it's good? It's going to change? No. What's the PPA state? There's no take or pay clear close. So what's the risk here? So do you need to take a bet or not? You see what we see is that countries try to, decrease, their commitments in the PPA. And that is a trend. That is clearly a trend, They start with requirements from DFIs, which are very strong to get, project finance. And slowly they try to ease a bit, and try to find some rooms where they give less guarantee, So how are you going to manage that, And developers, they tend to, not negotiate things, and then exactly as you said, actually, then they bring, a package where there are a lot of risk and gaps that could have been avoided if negotiated properly before. And once it is fully developed, resuming the negotiation with the parties is something which is sometimes, if not impossible, very complicated. And even more complicated, and it's possible in countries where the regulatory framework is not clear, like in Sub-Saharan Africa, there are not specific laws, etc. So we have this case in Burkina Faso. So we closed the deal in Burkina Faso with IFC. So it's, World Bank Group was, a very good investor and so on. So it's a kind of flagship project in the region. And we did it successfully. But how many times did we have to go back again and again to the government requesting to go to the Council of Ministers again and again, so they were seeing us, from far away, these guys that are coming, they are going to ask us to go to a Council of Ministers again, I don't know for which reason, so this is the kind of thing that you need to be ready for. And that's from sometimes, when you learn that during the due diligence process of the transaction is not good, so developers, they should have done this exercise before and be clear about that. We see that a lot,
No, that's really insightful, Kareem. Do me a favor, tell the audience how they can get in touch with you, and specifically what countries are you looking for developers right now, where maybe developers should reach out?
Well, open and opportunistic, when developers who feel they have good projects and they're looking for investors to either do co-development or to sell their assets at ready to build, or if they want to build and sell at COD, they should contact us. When we're going to pay attention to all requests. Now the size, now we say, we kind of choose our battles, to be honest. So the minimum size we look at is 20 megawatt now. And most of our transactions are above 100 megawatts. But, we can still look at, in countries that we like, that we see the possibility to close within the next 12 months. we're happy to start with 20, 50 megawatts, something like that. And we do solar and wind, usually utility. For us, it's easier, but there are some CNI projects. If the offtake agreement is clear and the offtakers have a good credit rating and it's not too small, it's not like small plants of 100 kilowatt, across the countries, etc., that we can't manage that. But if there are few buyers and few megawatt scale CNI projects, we can look at that. So frankly, all developers, they are welcome to contact us. I think I gave you a lot of examples and cases. So you kind of feel how the way we work is really, we try to adapt, to all projects, and we spend time to understand it. So, for us, all projects are kind of different, right? So we're happy to look at all kind of projects as long as the developer feels that, yeah, it's it's not just a PowerPoint, right? It's not just a few pages, or it's not too complicated, very, oh, my friend, they have these shares, we fight each other, etc. That thing which we're not quite, we're not fit for that.
No, absolutely. Personality and the personal issues are so important. You have to have a developer. If it's a developer team, hopefully they get along really well and they
Yeah.
hopefully they all bring value to the table. It's absolutely critical. Well, I have to say, Kareem, thank you so much for being on. There's a lot of insights that I think the audience will get from this, and they can find you at Orison Invest and also on LinkedIn under Kareem Megherbi. And we'll certainly put the link in our show notes. And it's been great. Thank you for calling in from Dubai today. I know it's later.
Okay.
It's about 1:30 here East time. What time is it in Dubai?
Yeah, no, it's 9:30 p.m.
No, it's crazy. So I'll let you get to bed.
Oh, that's cool. It's really enjoyable to talk to you. I really enjoy actually
Thank
this
you
time.
so
So it's
much.
very good.
Well, this has been Energy Superheroes with Kareem Megherbi, and he's got 17 years experience in originating, structuring, developing, and closing. That's the most important part, IPP transactions around the world. And unbelievable how much emerging markets. I don't know that we've had anyone on the show that really understands emerging markets the way that you do. So, emerging market developers, make sure you reach out to Kareem. This has been Energy Superheroes. Make sure that you look us on Spotify at Energy Superheroes and also on YouTube at Energy.Media. Thanks, everybody.